Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. We can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Oh, gosh. Hold on. I forgot to turn on the camera. Well. I'm just off today, I guess, man. But watching kids all evening, that'll do that to you, I think. All right, guys. Let's go to the charts right away, huh? Because we did just have a new move here. Moved up on that PCE news. It looks like the PCE, right, where are we? For PCE price index month over month, spot 1 versus spot 2. And the markets are responding positively to that. I don't know if spot 1 is a huge deal, but I'm kind of wondering if it's a bigger deal than the market has made it so far. But whatever, here we are in the treasuries. You see, yesterday we had a little bit of an incursion on the downside, but it was eventually able to hold, although it just kind of skidding along the bottom there. But now here this morning we are pushing on the upside. So above 19 is a pretty good spot. Above 19. Over here in the treasuries, sorry, the equities. Well, of course, that huge run-up that we got yesterday was going to come back, and it did, but we're still looking pretty good. I mean, we're still higher than we were before that move, so. Yeah, you know. It's always going to be a journey, right? Oil coming back down. So there's some risk premium in oil that has kind of come out. Now, I kind of feel like it should come back in, because this was like, oh, there's going to be a ceasefire in Lebanon, but like, then BB's like, what ceasefire? Again, they like said, oh, we're going to get this ceasefire through before they had even looked at it. So, pretty crazy. Gold doing pretty good. Silver, still doing pretty good. Kappa. Oh, yeah. And big move yesterday, huh? From that Chinese stimulus. Oh, and here's a Japanese yen. Okay, so there was an election in Japan, and it kind of seems like I don't know how to describe it. I read some stuff about his views, and it kind of sounded like a mainstream Republican, not like a conservative Republican, but like more a mainstream Republican. But whatever. Japanese yen is higher here this morning, and the dollar just barely at 100. Just barely at 100. Bitcoin is maybe starting to develop a little bit of a trend here, though. It's looking pretty good this morning. And, you know, if you compare it to like the amount of monetary stimulus that's been out there, maybe Bitcoin could go higher. If you're assuming that it's going to continue to rise along with, you know, that stimulus, which may or may not be true, right? Let's see here. I'm gonna turn this light is gotten screwed up. Let's fix that. There we go. Good morning, Octavius, A. Paul, and Uzi. I was kind of wondering last night, like, will he be there tomorrow morning, or is the storm gonna be? Because I'm hearing that like this storm hit Florida pretty hard. Huge storm surge, power out all over the place, and it's like it's coming together with another cyclone, which means that like they're gonna like dance there, and it's gonna rain for a long time. So I was like, will Uzi be back on Friday, or is he gonna go just right through it? Octavius, my 4th Hurricane G? Man. Well, it's not like I didn't think you guys could. I mean, I knew that you would survive. I wasn't like they're gonna die, but I was kind of like, will they have power on Friday? Like, this one is I've seen more about this hurricane than I've seen about any other hurricane in a while. So really, I'm in Central Florida and it barely rained last night. Little breezy, oak trees shed some lightweight, little cleanup, no biggies. It didn't even lose power. Interesting. Well, I think there's still some rain to come though for you in Central Florida. But I'll have to go look at the weather reports. Well, anyways, in the meantime, I do want to take a moment to talk about our Discord server again. So we made a new, well, it was suggested by somebody, and after thinking about it a little bit, I decided it was a good idea. $3 a month Discord server. I would make it $1 a month, except for that Discord doesn't minimum that it will let you do is $3. I'll post the link for you guys here in chat. Yeah, you can like go and join the server, but if you just join the server and open it up, you won't be able to see anything, right? You have to subscribe. So I've kind of been watching things and like the metrics that it gives me back and everything, and I'm sitting here wondering like, okay, so is it like people click the link to see what they can see, and then that's it? Because you do have to subscribe to come in and see stuff. But we do have some subscribers now too, so like I know that the workflow and all of the roles and everything work correctly. So if you've been with us on the Discord, and you're interested in more content, because I am going to be putting more content on the Discord, go and join that Discord. It's $3 a month. And well, I mean, part of the impetus was that I've been let go of my job this week, and so we're looking for some ways to generate some income. But I'm pretty skeptical that that's going to get to the point where it could really make any kind of realistic dent. But there's also the robots. You just, on Discord, there's so many robots. So having a private paid server, we're hoping, well, we're hoping. I mean, that's going to stop the robots from contacting you, right? So you look like One Punch Man? Why do I look like One Punch Man in particular today? Because like, and I mean, especially when I got the beard, like, don't I have to be completely clean shaven to look like, oh, I look like One Punch Man in the Discord? That's hilarious, dude. Yes. You know, so I took a picture and sent it to ChatGPT, and it made that picture for me. And I was like, okay, that's just what we're going to go with for now. But it didn't put a beard on it, which I thought was kind of weird. I was gonna, you know, I would like to be One Punch Man for Halloween, but I think I have to make like a really fancy cape. I'm really gonna do that. I have to have the like the nicest cape, you know. But I don't think that's happening this year, man. Everyone wants a hurricane to be the worst nature is capable of, but no one wants to admit it. Oh, you know what? I totally get what you're saying. Like, I think that's kind of like would be something I would feel nervous saying, because like, you don't want people to think that you want bad things to happen. But like, I think that people kind of get excited, like, okay, we're going to see something super cool and something super interesting is going to happen. You probably think that up until the point at which it like blows your house over, right? And every time one comes around, I'm reminded of how many people in our society would be absolutely useless, if not counterproductive in an emergency. Yeah. You know, like, it's like 50% of people do not do any kind of exercise at all. It's pretty wild to think about, because like everybody that I know exercises. Whatever. So I've got a little bit of oatmeal here. I don't know why, but I was just kind of a little bit slow this morning. Is the drudgery of unemployment getting to me yet? No, I don't think so. But I don't think that I did as well as I could yesterday, because there was some things that I wanted to do yesterday that I didn't finish. So hopefully I get some time. The thing was when I got laid off, my wife's like, okay, I'm gonna pick up as many flight trips as I possibly can. So she's working pretty much every day now. And so we got my mom to come and watch the kids yesterday, but then after that, I watched them on my own from it was like 5 o'clock till 9 o'clock. So like 4 hours. And I find watching the kids very taxing. Because it's like, for a neurotypical person, probably no big deal. But for me, it's like I have to focus on the kids the whole time, and it's rough. And there's not a whole, like, they're kind of in a stage where it's kind of hard to occupy them. Oh, does my stream say that it's August? No, you're right. Oh, jeez. Wait, so does that mean that, like, man, you guys, you gotta be on top of this. I rely on you guys to point out when the title is stupid. Does that mean that, like, all of the live streams from the last month are say that they're August instead of September? Please no. Please no. Size at 21 and 21 and a half. Well, let's recenter first of all, huh? I'm kind of thinking that we'll continue to float up, although it will be a pretty slow one. And it's a Friday, so I don't really like trading Fridays. Content. Live. August. Oh my gosh. Going all the way back. The whole month is screwed up. Why? How did I screw that up? Well, I'm gonna fix this. This is gonna take a little bit. I've got some food to eat, so I'm gonna go quiet here for a second. You guys keep talking. It's like fat thumbs. Okay, let's see here. Did I get them all? Refresh. September. Nope. September. Isn't as many trading days in September as I feel like there should be. All right, there we go. Here's a thread on Reddit. The Fed slashed interest rates last week, but Treasury yields are rising. What's going on? Still need to chill out. Well, the reason you're all kind of like, what's going on, is because you think that the market is perfectly efficient and that current prices must be reflective of all available information. And the simple answer is, they're not. Markets are affected by all sorts of things that have absolutely nothing to do with the fundamentals, and those orders all have impact, regardless of why they're being submitted. So, it can be the case that the current dynamics in the Treasury market, because of things like end-of-month flows and who knows what else, can push yields higher in spite of like the longer-term fundamentals. Although I also do kind of think that there might be this thing that like, that was like maybe the easiest that the Fed was going to be, and that we would need to see a lot more negative information about the economy in order for Treasury yields to start declining again. Because basically they're thinking that like they brought forward, or maybe they were doing catch up with that 50 basis point cut, but that from here on out the risk is that the Federal Reserve is less easy than the market was pricing, not more easy than the market was pricing. Because the economy actually is looking still pretty resilient on some measures. Even though we did get some data last month that was a little scary. Jose, you're very good. Most people can't read that. Yep. So the top you got all correct. The bottom is oil and then the micro treasury yields. So these are the micros 2, 10, 30. And the micros are priced in terms of yield instead of in terms of price. So when I take trades lately, I'm usually doing it down here because I'm super risk adverse in trading a small account. So, you know, $10, win or lose $10, that's kind of like the sort of trade that I go for. I don't know if I'm going to take one today. Well, you know, I'm not sure if I'm going to take one. I have to take at least a few trades every month, but I don't see myself trading a whole lot in September. One, because I think that the kind of opportunities that we do get will probably be the kind that I'm not going to have a very good edge on. You know, I'm not going to be ahead of the curve on them. And also because I'm just not really in a very good place to take on risk because I lost my day job right now. So, you know, I have some stuff saved up, you know, in case we need to like refund the account, but I might have to take that and live on it. Not that it would make much of a difference, but and I guess I still need to replace the headphones, but these headphones are working okay for now, so I think I'm just gonna like leave it alone. I think I'm just gonna leave it alone until I absolutely have to replace them. Never trade the yields. I watch the 10-year, but I trade GC, CL, YMES, RTY. So, well, that's interesting. You know, there's a real advantage if you switch instruments when instruments have momentum going on that day. But, you know, as of late, we've had a lot of days where all of the markets are just quiet and range bound. So... I'm not a fan of this song because the way that the guy goes, like, I know that they thought it was hilarious when it happens, but like, it just stands out too much for me. I know what they're doing and I don't think it's funny. Of course, I muted myself. Durr. So I was just like, I had a really confused look on my face, so I'm trying to explain myself now. I got a message from the Missouri unemployment. Our unemployment claim was denied. You are not an insured worker in Missouri. You're not eligible for combined state wage claim because you do not have wages in Missouri. Okay. Because I was told that I have to file from where the company is. But did the company file it in Utah? I guess. Well, if I was supposed to file in Utah, though, that really helps. That actually really helps and is like a real good thing. But yeah, it depends on which state the company pays its unemployment tax to. So, like, my first question, though, is, do they... Was that because of something that I did in the claim that was wrong, or are they correct? So now I kind of want to be able to come in here and see. Will it let me look at what I put? Well, not even letting me look at what I put. Or do I just not worry about it and file in Utah? I don't know. I would have filed both. Well, so I did kind of go into the Utah system and looked at it. But I was assuming I file for the one and then because it goes back to by quarters. So anyways, but it turned out that my older job didn't fit in quite right with the way that Utah does it. Difference between the way that Utah and Missouri does it. But I would like a translate. You know what? So coming back to this one, granted, I know that you cannot see what I'm looking at. Where would I, I don't remember putting any, I wouldn't have put anything on there that was what they say employer Utah CWC interstate unit. What is that? Where did they get that from? That must mean that they looked up my employer and they found that it was in Utah, not. I don't know. But I guess I'm just gonna file in Utah after the stream, of course. But that's probably better because let's see. maximum benefit amount is 746. That would help a lot. The maximum weekly benefit amount. Well, but let's see here. Let's go. I'm just kind of assuming that I made enough that it would be over this, you know, that it would always be the maximum. But let's see. Yes. Okay. But that's okay. That's okay because I So I'm still like a little bit nervous here and everything. Like I hate paperwork, man. I hate paperwork, and I'm super nervous that like I'll do something wrong, you know? And it's like, oh, I could have gone straight to Utah and I could already be getting payment, right? Ugh. Okay, but the Utah unemployment is like way better and will help me, will get me through. Like yeah, it's not nearly as much as what I was making before, right? But it's enough for me to survive long enough to get another job. And let's see here. And you can do it for 10 weeks. So that's like 2 months. I think we're gonna be okay, boys. We're gonna be okay, boys. Yeah, I mean, you probably don't care. You're not with me over here. I think that it's gonna be okay. Even if like even in some of the worst case scenarios, I'm gonna be okay. Yeah. Because that's like good enough. Okay, so I joined the new Discord. I can't. Well, but did you actually subscribe? So you can join the server. It will let you join the server, but when you join the server, if you're not subscribed, it should just not. Oh no, wait, Octavius, you have paid, and you don't see any channels. Can you send messages in general? Because Greg was able to. So I guess first question. Let me try and show you. Let me see if I can do this. Like show you. Okay, I come over here and I say preview, and I select here supporter. Okay, yeah. So when you come over here, you should be able to see all of the channels. Interesting that you don't pop up over here. Oh no, wait, there you are. You're right there. And should see it in welcome. Yep, there we go. So what does it tell you? Is it like you go to the general channel and won't let you type anything? Or is there a particular channel you're trying to type in? So first thing is try general. Because Greg was able to post in general. And then maybe it's that I don't have the permissions set up over on these other channels, correct? Actually, I guess I can kind of check that, huh? Here, the channel permissions. Permissions synced with category main. permissions sync with markets. Let's try that. Markets, permissions. What's the new Discord channel name? Oh, let me grab the link here again. And just give you the promo page. There's the promo page for it. See, I can post. Alligator can post options, of course, because we're the moderators. But I'm in. Oh, I see you typing. Cool. Now, are you able to post in the interest rates channel too? Did you have to do something on your side, or was it just waiting long enough? So now I'm thinking about it. Kind of going like, maybe I should make a new channel. Learn more organized discussions. Waiting, and then I did a invite to you and got in. Oh, wait, that doesn't make any sense. Okay, whatever. So I want to make a forum channel, so that you can like post links to stories and things like that, and then it would be like forum style discussion on those particular stories. I think that would be useful, but what should I call it? I don't know if I should just call it links. I'm just gonna call it links. Great channel. Welcome at the top. news. Analysis. Making tags. Sort order will be by creation time. Hide after inactivity. Can I just have it be never? Why is it like that? Okay, whatever. Wait, it's still Octavius. Just go and just say hi in the interest rates channel, just so that I know that that markets category works correctly. What should the first post be? What's this? Whistleblower. The Biden-Harris administration is sabotaging Trump's campaign. With the election nearly a month away and Donald Trump seeing some momentum in these final crucial weeks, the Biden-Harris administration... It's a month away. I mean, it still seems like it's a long ways away. Biden-Harris administration may be trying to undermine Trump's ability to campaign in key swing states. We're now learning that Trump recently had to cancel a planned rally in a battleground state of Wisconsin after the Secret Service denied him adequate protection resources. Yeah, this one is a little crazy. Like, that you don't have the they can just say, oh, we don't have the resources for that. Josh Hawley addressed the issue in a letter to the acting director of the Secret Service, Ronald Rowe. He referenced allegations from a whistleblower who claimed that the cancellation was due to the agency's lack of sufficient assets to ensure the safety of the Republican presidential nominee. All right, concerning a new whistleblower allegations that the U.S. Secret Service effectively forced the Trump campaign to cancel an upcoming event. This new information calls into question your recent public statements regarding the level of security your agency is providing to the former president. It also suggests that the Secret Service's inability to fully protect former President Trump may be affecting the conduct of the, and then it breaks off. I think that they zero hedging, you fix that. Anyways, this is a serious claim, not just because it raises doubts about the ability of the Secret Service to protect Donald Trump, but also because Wisconsin is a key battleground state. Trump narrowly won Wisconsin in 2016, only to lose by approximately 20,000 votes in 2020. While Kamala Harris has a slight advantage in Wisconsin, according to the polls, she's polling behind where both Biden and Hillary hold in their respective races against Trump. If the polls in 2024 are off by a similar or even slightly smaller margins this year as they were in past years, Trump may be marginally ahead in Wisconsin. Hawley continued, at your recent press conference on September 20th, you stated that former President Trump is receiving the highest level of Secret Service protection and he's getting everything that the current president has with respect to Secret Service assets that same night. Secret Service secured a rally for Vice President Harris in Madison, Wisconsin. Yeah, but maybe it was the size and nature of the rally that you wanted to do. So the Secret Service, an agency under the Biden-Harris administration, is essentially weaponizing federal resources to stifle the Trump's campaigning efforts in a pivotal swing state. Yet, according to a whistleblower with direct knowledge of the exchange, Secret Service recently told the Trump campaign that it did not have sufficient resources to secure a potential campaign rally in Wisconsin for the former president. Other whistleblowers with knowledge of Secret Service planning protocols allege the failure to provide protection for a major public event is highly unusual and that a sitting president would never be denied resources in this way. If true, this apparent double standard contradicts your public statements and it raises questions. Once again, it looks like the Biden-Harris administration is weaponizing the federal government, says Zero Hedge. Well, I was aware of that story yesterday. Actually, it's kind of been brewing for a couple of days now. Trump criticizes Zelensky, reveals private message just before Friday meeting. Oh, yes, he is meeting him today. The former president charged Zelensky with making little nasty aspersions towards him. It's a shame. What does that mean? Okay. And then he posted the full message. Dear Donald, hope you're doing well. I recall our recent phone call. It was really good. All of us in Ukraine want to end this war with just peace, and we know that without America, this is impossible to achieve. That's why we have to strive to understand each other and remain in close contact. Days ago, we requested a meeting with you, and I really want to hear your thoughts directly and firsthand. I know I always speak with great respect about everything connected to you, and that's how it should be. I can be in New York on Friday, which should be a good time for us to meet. I believe it's important for us to have personal contact and to understand each other 100%. Let me know if you're in the city at the time. I would really like for our meeting to take place just as part of our efforts to help us. You know what this is? This is theater. It's theater on Donald Trump's part, right? You come in and you be all dramatic about it and, oh, you know, like there's a problem with Zelensky and him and all of that. And then they come and they have the meeting and it's a great meeting and everybody is happy and it's this huge victory, etc., etc., etc. Right? That's what that is. I mean, I didn't man. Oh, I'm sorry. What was your question last time? Okay, we were talking about edge and statistics, and I asked you. Now he's typing a much longer thing. What are your thoughts on traders like Tom Hogarth and his channel where they keep his trades pretty transparent? Well, so I've never been on his channel or anything like that. I think that you're very unlikely to become profitable by like following somebody else's trades, right? So you know, that's the way that most people think of it is like, oh, well, it's legit and I should do what he's doing, or I should just like shadow his trades and then I'll be a successful trader. And it doesn't quite work like that. Like the issue, the thing that you got to keep in mind, and I think the key realization that will completely shift the way that you look at trading that new traders have a hard time kind of coming to, is that because this is a competitive game and it's a purely informational and mental competitive game, you know, coming out and giving people all of the information about how to do a certain thing will harm your profits. And there's many studies about this sort of stuff. So it's basically like there's some edge out there, like some sort of arbitrage or something like that, right? And you're trading it, and then some other large player comes along and is also trading it, and then you're going to have to share those profits. So each, the two people that are trading it now, they have to split that, and they're going to make less, right? And it will get to the point where, enough people are trading it that there's not an edge in it anymore. It just disappears. Right? So you're never going to be able to just, take a template from somebody else and translate that into profitability. It's like if you find something like that, it's probably not going to last very long because it's out in the public sphere, right? Okay. Your strategy is damaging to your profit. Yeah, us retail traders contribute no less than 90% of it. Well, yeah, but you got to keep in mind that orders have a very strong impact, right? So, so we need to talk about the square root law with you. But is there anything else I need to establish here first before we dive into that? Because this is pretty deep. SMB, a New York firm, insisted that you share your strategy. Well, if you're trading it and they want to know what you're doing to, so that they can know what potential risks there are with it and everything, that makes sense. But you don't want it to be public, right? You don't want your strategy to be public, right? So, I guess, so the thing that I would say, because my understanding is that Tom Hogarth has had success in the past, okay? That doesn't mean that you want to trade exactly his strategy, right? Instead, what you should be looking at when you look at him speak is how did he find that? Because learning how to trade is really about learning how to develop a good strategy that will actually work. Because finding a strategy that actually works is very, very difficult. So that's kind of how I would approach it. Okay, so let me explain the square root law. So the square root law is this, okay? Let's say that you have $1 million and, no, like $100 million. Let's say that you have $100 million and you're going to buy futures with that, okay? So you're going to be buying several, tens of thousands of futures contracts in this market, right? That's going to move the market up, okay? How much is it going to move the market up? Well, we can kind of test it, right? So you do that trade and you trade 50,000 contracts and you see how far the market moves, right? Now you would think that if you trade double that, so now you trade 100,000 contracts, the market would move twice as much, right? But what we find is that actually it doesn't. It follows the square root law. So it will move about 1.41421, or the square root of 2 amount as much. So when you draw that, it looks like this, right? There's kind of like this upper limit. And we find that this kind of has to be so, because if it didn't, then there would be too many arbitrage opportunities between other instruments and so forth. Okay. So this kind of leads to an interesting kind of conundrum, which is that, this is kind of advantageous to large players, right? Yeah, a big player moves the market, but the bigger and bigger they get, the less of a concern their movement becomes, right? And so the reality is that on a, if you were to say, what is the impact per contract? The impact per contract for your orders is higher than the impact per contract of the big guy, essentially, right? And so what this means is that relatively those small innocuous things can, in the right situations, have a really strong impact. So let me approach this from a different direction now. Let me approach this from the algebraic position. So I just showed you the square root law, right? This is the actual formula, okay? Is the impact of order Q is equal to y, which is a scalar unique to that instrument, times omega, which is the average volatility of that instrument, times the square root of the size of the meta order Q over the volume for the time V. Okay, now what if we were to come in here and we were going to say, I'm going to trade 1% of the total volume. Okay, so we're going to replace Q with 0.01 V over V. Okay, the square root of that. And what is that? Well, the V's cancel out now. So now it's the square root of 0.01. And what is the square root of 0.01? Well, square roots do weird things to decimal numbers, to numbers less than 1. And so the square root of 01 is 0.1. Right? 0.1. So what does that mean? 1% of the volume can be responsible for 10% of the volatility during that time. So are there situations where, even these tiny retail traders can have yes, especially if it's, a group of retail traders all trying to trade the same signal. Okay, so do you think that intuition plays an important role in your trading system? And if so, how can one incorporate it to correctly backtest? Let's see here. Tom Hogard lost all of the Danish official trading competitions. Don't know him personally, but the way he trades is not for most people. Okay. Wait, how does he trade? I mean, I'm going to guess that it's taking on risk, but who knows? Okay, so the way that I approach it is this. So intuition, I think, is a very important part of trading as a retail trader, because there's all sorts of mechanical setups out there and everything, but anything that's like that, the robots are gonna catch. The robots are already gonna have arbitrage that out of the market. So in order to find an edge, you're gonna have to do something more complicated than that, things that the robots aren't very good at yet. And so that's where intuition comes from. So how do you develop that intuition? Well, the key thing here is that you want to develop that intuition based on information that is correct. And that's where most retail traders have issues and are never really able to develop that. You'll get into this point where it's like there are some traders that have been like amazing traders. And then when people try to say, well, okay, so let's automate your trading, or, what are you doing? And they themselves, the trader themselves, don't understand how they're doing it. That is the key sign that they're using intuition, right? So why is it that some people develop that intuition and some people don't? Well, maybe those some people that did develop that intuition were just lucky, right? Because they're trying things and they have the right experiences that kind of wires the intuition in their brain in a certain way that it happens to get the correct answer or a better answer than other people, right? We don't want to be, subject to it's just luck of the draw as to whether or not you figure it out correctly or not, right? So what we want to do is we only want to incorporate information into our process that we know is correct, essentially. So that's why it's important to understand empirical properties, proven empirical properties of the markets, things like the square root law, things like that, the market is not perfectly efficient. So if a news story comes out and the market goes up, that doesn't necessarily mean that news story, made the value of the stock market higher overall. It means that people submitted buy orders, and what were the reasons that they submitted those buy orders. And sometimes it's not necessarily what you would think, and that's why we get all of these situations where a news comes out and the way that the market reacts doesn't completely make sense. But if you understand these things and you can kind of systematize, like, okay, so here were the different potential things that might have driven that flow, And, you know, we kind of do some detective work over time, and you might be able to figure out why a certain move happened and what was driving those flows, right? And then you have that information that you can then incorporate into that machine learning network in your mind, so that someday there's going to be a headline that comes out and you're going to immediately know just by instinct what should happen, and you can get in before everybody else and take advantage of the move. And that's how you use intuition in your trading. But the key thing is that let's only look at things that we know matter. Only look at things that we know matter and we know the properties of. Because if everything that you're looking at is noise, then your brain is going to try and optimize that noise, and it will just, you know, garbage in, garbage out, right? But unfortunately, there's no way to like back test your intuition. That's correct, right? We can make sure that all of the things that we are factoring in and that we're using to develop that intuition are things that we know are correct. But at the end of the day, you can't really back test intuition. So, and so that's why the second thing that I would do is, while you are still developing that intuition, I would focus on equal risk reward trades. Equal risk reward trades give you the best feedback, the best and most immediate feedback about, you know, whether that was a good trade and how good your process is. If you have a skewed risk reward ratio, like that you always win, then you're going to over extrapolate the results and you're not going to develop a very good intuition. And that's, again, another thing that happens to a lot of retail traders, is that they think that they're gods because they're taking this really skewed risk reward and make money 80% of the time or whatever the deal is, right? And then when something interesting actually happens in the market, they get destroyed because they don't understand how bad their intuition actually has been, because they've been trained to always win. And then when they're in that situation and they're not winning, their psychology just completely falls apart, right? And they tilt and they blow the account. So that's how I would approach it. Trades, pure price action, and proper sizing. I mean, that sounds like you're taking on risk, right? I mean, I would be really, so like, I think that one of the issues that we have is that we want to be able to say, like ultimately, what do retail traders care about? Does X strategy work or not? This is really what it comes down to, right? So the easy answer is, if you read about it on the internet, it doesn't work. Right? Okay. But one of the things that you'll say is, okay, well, there's this trader out there and he is promoting this style of trading and he made some money, so that must mean that strategy works. No, that's incorrect. That's incorrect. They could have been lucky. They could be lying. They could be, there's like any number of factors behind why they maybe had success and you might not. It might be an edge that did exist there but doesn't exist anymore. That's really, really common, is like, you have a strategy, you do well with it, and then when you're not doing as well with it, then you start to sell the education to people to make up for it instead. Okay? I'm not like trying to bash on anybody specifically. Like, if people offer education and it's good education, then good for them. But, you know, but if it's in the public sphere, the edge is probably not very good. I'm not trying to give you guys like a straight edge. I'm trying to help you understand, here are the things that we can look at and that we know matter, and the things that we know about the way markets behave that other people aren't telling you, even though it's like very well proven in the literature. You use that to develop your intuition, and I think that you stand a much better chance of having success than you know, the other stuff that you're hearing out there. Okay, nobody else teach like this square root law stuff. You're only going to hear about that on this channel, even though it is like the most established empirical results on like short time frame stuff in studies, the financial literature. No retail traders talk about it. We talk about it. It's a very important thing, right? You're only going to get that here, and I think that you stand a much better chance. The guys that we have here on this channel that are here every day, they've been here every day since like the beginning, most of them. I mean, like we're talking 5+ years. So how is it that we have a channel where 80% of people don't even last more than a year, and this channel is full of guys that have been doing it 5+ years? Why is that? Well, it's because the information that we have at least gives you a fighting chance. I'm not going to say that it's going to make you rich or that you're going to be profitable or that you're going to be able to make a living from it. Probably even after all that, you're not going to be able to make a living from it. But you'll break even. You'll be able to continue doing it. Yeah, I rarely jump strategies or watch any new technical videos. I just go back and review my journal and write feedbacks, I believe. Ritualistically do your trade write-up and gather data and info to improve your edge. No, I think that that's the right way to go about it. But I think that the big thing that you might do, though, that kind of screws you over is caring too much about perceived patterns in price, which essentially is price action, right? So if what you're trying to trade off of is price action, just know the price on short time frames is extremely unreliable. So we can predict orders, and there are some situations where we can predict orders with really good probability, right? And then you get good trades. But if you're trying to look at the past price, you're not going to see that, because there's this randomness injected into it, right? And the randomness that's injected into it is bigger than the kind of like the imbalances in the orders that we're looking for. You would never notice it unless you knew about these empirical properties that we have, right? So for instance, that if you're seeing autocorrelated volume, then that tends to persist for long time. So if they're buying now, they're likely to be buying in an hour. If you're trying to do that with price, you say, well, if price is up now, then price is likely to be continuing to go up in an hour. No, because they inject that randomness into the price. But if you follow the orders and you stay in it for an hour, then you stand assuming that you actually do have a meta order and you're correct. Right? So that's what I mean, is like the edge, they hide it by injecting this noise into the market. So the only reason why I bring that up is because you brought up Tom, and based on what I've heard, he's doing price action. Well, so if he's doing price action, probably what's happening is he's got skewed risk reward of some sort, where he wins most of the time, and then he just has developed enough experience in the market to know like when a bad time to actually trade that is, I remember I said you trade your account, which is extremely small, because this seems like a side gig for you, and that you're right. Yeah, I didn't. Well, the account that I've got right now is less than $1,000. Less than $1,000. And when I have a good month, though, I will make like 50 to 100. I think the best I've ever done is 200. So like based on a percentage return, that's actually really, really high. Isn't it kind of crazy that even to trade like a $1,000 account and you're making $10 at a time in micro treasuries, that's still like kind of over leveraged to some extent. Yeah, but it is. Over what time frame? You want like my most profitable month, or do you have? So I wouldn't call it fixed. Since oh man, since the very, very beginning, it's going to be way, way, way. Right? What am I looking for here? Oh, there we go. Oh man, if you go from like the very beginning, I'm gonna say it's probably $2,000 I've lost over the whole range of things. Maybe more than that. Let's see, where am I supposed to go? Oh, dashboard. Like if I really go back. Was it because you were testing out your strategy? Well, I think that at the very beginning, much like most people, I was kind of shooting around in the dark. Like I had been given some guidance from some traders at a bank. They kind of, told me some of the most important things, but I didn't really know how they knew those things. And, so I wasn't really able to rely on them and trust on them in the way that I do now. And during the pandemic, was when we really learned a lot of these things about the markets, and I was able to really make some shift in my trading. So now for the last, well, it's been a while now, so I'd say it's almost been the last 2 years, we've done pretty okay. So there you get this thing where it's like, what are you going to count? Like, you can count live trades, sim trades, these kinds of sim trades, these kinds of sim trades. Like, if I go to my sim trades, you get like this crazy stuff where it's like, oh, I was screwing around, and so one day I had a trade that worked really, really well, and then the next day I had like that same size on and it lost it, and it was like hundreds of thousands, which I would never be able to do that in life, and so it screws all of the results up, right? So then I go in and I'm like, let's just use only live accounts. And I've had a number of them over the years because of like switching brokers and stuff. I don't know what that one is. I'm not going to put that one. I don't think that's on my live account. That's probably like a funded account or something like that. Let's try that. Yeah. Oh, it's actually 5. It's actually 5,000. So like I had like the beginning, and then I lost like 2,000 this year, and then 1,000 here. Yeah. A lot of it is commissions too, right? Then we go to just this one, which I think is that. Yeah. Okay, so I did really well last year, and then I did very poorly at the beginning of this year. Actually, that was the end of, was it the end of, yeah, because that's like December. That's like last December, right? But then, after I recovered at the beginning of the year, then I've been doing okay again. So, yeah. Work in progress, right? How would you avoid that drawdown? Well, so the reason that happens is because you don't understand that market well, right? So I think that a normal person, they would probably completely draw the account all the way down and lose like multiple thousands of dollars during a situation like that, right? Whereas I'm able to minimize it, 10, 20% drawdown, something like that. That one is like a 20% drawdown for me of the total capital I have available for this sort of thing. So, you know, that is kind of managing the drawdown, I think. But why does the drawdown happen for us? Is because we don't understand that market very well. So it's kind of an issue of being able to understand when you don't know what's going on and just not doing anything. Thanks. I rarely jump on your streams during my trades, but I'm glad I check back once in a while. You always give gold. Oh, thank you. Yeah. But I mean, I guess that's like this larger thing is that I don't make any performance claims because even when I'm doing well, you know, like even when I was over here in this area, you know, when we were doing well and people would be like, oh, you're great. You should be, you know, that was like 6-9 months of profitability there, right? That's where a lot of people would get on Reddit and be like, I'm a genius and yada, 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 yada. And you know what? Especially if I did the risky stuff, you know, really amped those trades up with risk, you know, that could be thousands of dollars that I made and all of these sorts of things. That's what a lot of people do, right? But I knew at the time, well, past performance isn't indicative of future results. So I never rely on, okay, my authority, the reason why you want to listen to Seth in this channel is because he's been a great trader that's made tons of money in the past. I really think that if you're just like break even, and for me most of the time it is just break even, that you're doing pretty good. So I don't rely on that performance at all. Instead, what we do is we say the things that we're talking about, we know are backed by empirical evidence. It's not just this is what some guys, you know, also a lot of stuff in retail trading is really, oh, this one guy, he had this idea and he seemed to be pretty profitable with it, and then everybody's been teaching that since then. And that's why so many of those ideas end up being complete nonsense and frankly harmful. Prevent you from really being able to find good edges. Curious that Octavius is going for another long there, huh? But that kind of drawdown that we got just before the S&P 500 opened was a little odd too, though. But I don't like taking trades on Fridays, man. Fridays can be tricksy. I think some of this include no. It's like overall over the 2-year time frame, $500 down. That is correct. That is correct. Over 2 years. But I don't know. Well, here's the thing: is like most people that come in and do this lose thousands. Man, I can't tell you how many times you go on Reddit and they're like, I blew $50,000 or this thousand. Like, how are you doing that, guys? How are you doing that? It's so crazy. Well, I know. One thing I'll just go into like the stats just to kind of explain to you. So like if I come in and I look at what is my average MAE and what is my average MFE, I would like my MFE to be above 10 and my MAE to be below 10. So to some extent, part of my problem has been taking bigger losses that I want. But really, the real killer is this win rate right here. You can see that my percentage losing trade, like 52%, is, you know, like what I really want is my percentage winning trade to be close to 50% and the losing trade to be more like 41%, and then some break evens in there, you know? So basically, because I didn't know what was going on and I didn't really have, you know, I made a couple of calls that were just dead wrong, essentially. And so the win rate's not there, right? That's where that come from. So the period where we did well was the period where, you know, like treasuries were popping off and everything, or not popping off, but like getting slaughtered, actually, like trend down because of inflation. We understood that market really well, right? And that's another side of it is, well, if we ever go back into an easy money regime where treasuries really shoot up again, like the kind of regime that we had from 2008 until 2015, I would say 2016, like before Donald Trump became president, then we will probably do really well again. And that's another thing, is that a large part of your performance has to do with the instrument that you're trading and all of these sorts of things, right? I would like to do something where I'm trading multiple instruments and doing a swing strategy, but yeah, need some work still to be able to make it work with the size of the account that I want to do and stuff. I don't know, I'm a little frustrated. I was thinking that next year I would be able to start some of that stuff, that I would have enough saved up to be able to start some of that stuff. But now I'm concerned that I'm going to have to dig into the savings. So that might put me back. We'll see. Hopefully I just get a new job really quickly. That was a good short on the markets during elections. What you talking about back when Donald Trump got elected and the treasuries just like dish? It was like the single largest one-day move in the treasuries ever. Oh my gosh. That was like when I first started trading, and I was kind of like, why didn't I not? Like, it was crazy. And I just kind of watched it. It was before like we were streaming and everything. So we started streaming in like April of 2016, 2017, I think. I think when I'm discussing some of these things, I get a little bit too scatterbrained, right? Because what I should have just said in the beginning is, well, I never claimed to be a profitable trader, and I'm still down on the year. Like, I can show you the stats, so I don't understand why that helps or why you would care to see that. I guess one of the things that's always in the back of my mind is, well, probably the reason you're asking me that is because you say to yourself, oh, maybe I'm projecting, because this is what I did, is I said, you know what actually I want to do is I want to be a trader for a living. Well, listen, if you want to be a trader for a living, make that decision when you're in high school, get the best possible grades that you can in high school, get into an Ivy League that you know the banks and hedge funds, etc., draw from, and then try and get hired into that industry right after graduating from university, and go into finance and or quant finance. That's what you got to do. Now, I didn't realize that's what I wanted to do until I was basically just about to graduate from university. So, hey, you know what? Site reliability engineering is a pretty good gig. It's a pretty good gig. Yeah, I'd make more money than I thought I would, and more money than I need. Like, this is why I feel a little bit relieved today, because basically I made so much that the unemployment is like enough to cover all of my expenses. Does that make sense? So yeah, it's a good gig. But if you want to trade for a living, work for a bank. What we're doing, you might have success, but there's going to be a great deal of luck in there. It kind of has to be like kind of one of the things that I think is that for the most part, I don't really believe that there's enough edge lying around for retail traders to pick up to really have the kind of consistent profitability to live off of it completely like retail traders want. I just don't think that that's there. The people that seem to be making that are almost always taking on risk, and so like they'll blow up. Okay, that's a big problem. It's like within a 2-year time frame, they almost always blow up. So yeah, I don't know if that kind of edge is out there. But the thing is that like markets can change, right? Like new things can come in, and you can be on the forefront of that, and then that's when you become one of those stories that proves to everybody that retail trading can work, right? Like most of the stories that we get about retail traders making tons of money from the market comes from like the early 2000s when electronic trading was brand new and the robots weren't around. And so these retail traders were taking advantage of things that they had found within the electronic trading world that aren't really available to us anymore, right? So you can, if you practice, if you really know what's going on, and I really think that of all of the people in the retail trading community, that you guys that come in here every day and are listening to the stream are going to be the best prepared to find those sorts of opportunities. The one caveat is it's probably not going to be in treasury, so we got to be keeping an eye out in other assets and things to see when an opportunity like that arises. Yeah, even BlackRock can experience losses. Market uncertainty, investment risks, and I was doing a lot of reading, so I'm trying to read this book as quickly as I can. I haven't been able to marathon it quite the way that I wanted, because I wanted to be done with it like last week. I'm to the last 30 pages or so I'm pretty close. I might finish it today. And one of the things that the book talks about is based on their models, things like leverage, and the way that credit is given, the way that credit works, let's say, kind of creates bubbles and crashes on their own. So again, it's like they're almost like an inevitable part of the market to some extent. So like his argument, and this is like one of the things in finance that like irks me the most. It's not like my topic du jour, because my big topic is that we have basically cut out the middle class from directly owning stocks by convincing them to put it all in 401ks, and so now the public companies aren't really public anymore. That's like the cause that I care about the most and want to get people aware of and make an impact on. Okay. But if there's like a topic that kind of like, makes my eye twitch a little bit, it's when people say that the reason the 2008 crisis happened was because of corruption at the banks and people breaking all of the rules and all of that stuff. It's absolute bullshit. Okay. The rules of the Basel rules, which are basically rules about like what kind of assets you can have and what amounts and how you manage risk and everything. The risk rules make crashes like 2008 inevitable. It was always going to happen. It had nothing to do with like all of the, that's just like a scapegoat. Like you something kind of big and nasty happened. Surely somebody had to do something wrong, and we have to go and find them and punish them for it. But the truth is that the very rules of the system were what crashed it. It was the regulations that Congress had put in place made it happen. So whenever I'm watching like The Big Short, like it's an interesting movie and it's a great, I love watching it and everything, but like the central premise of the movie as to like why it happened and everything is wrong. The 2008 crisis, from the research that we have, the 2008 crisis was baked into the rules of the market. It was a market microstructure problem. I like to ask this question. Every trader I meet is a market random. I suppose it depends on what you mean by random. The market is not like random, which is to say that like, so like a random market would be like, every minute I pick a random number between 0 and, 1% of the value or something like that. And then that determines what that bar looks like, right? And that would be a random walk, right? Well, the market doesn't work like that. There are many properties of the market that differ from what you would call a random walk. For instance, volatility clustering is a really big one. When you get a big move, you're more likely to have big moves. And when you're not having a lot of movement at all, you're likely to continue not having any movement at all. Volatility clustering. The square root law is a property of market that does not match up with a random walk, for instance, right? So there's many properties like this that we can look at that show that the market is not random. Okay, so the market is not random. What it is chaotic. The market is chaotic, which means that there are a large number of variables, and those variables can differ very widely. And any one of those individual variables can have a very wide varying effect on the market. So it's this sort of a thing where it's like you have this system and there's a little control board with like these different little parameters, and then you change those parameters. And it's like if you change that parameter even by 100th of an amount, it can completely change the system, right? So it's a chaotic system is what it is. It's not random. In fact, if we want to take it from the perspective of orders, right? The market does what it does, orders in, orders out. Like, so if you take all of the orders, all of the orders that are going to be submitted in the next hour, you can predict exactly what the price is going to be. It is, sorry, what is the word when it's like a function and you know exactly what is going to come out. Oh yeah, sorry, I was talking and I forgot about you. What's the question here? Yes, for the resting orders. Let's show this. This is an interesting picture, actually. Oh, okay. So you have level 2 changes on here. Oh, you're talking about resting orders. So that one depends a little bit more on which ones you put on. I think if I come over here into the indicators and I pull it up and I say speculator Sept, resting orders, this one right here, there's like a bunch of subplots and I can't tell which subplot you have turned on, because shouldn't you should see 2 lines. But I can see here that yeah, how come, am I looking at this wrong? Oh, actually, it's just really no, that's not right. Oh, did you like add it on twice, and one is this one must be max bids, and this one must be max asks. Yes, yeah. You just I would expect this one to be up here, but yes, that is what it means. This is like the zero is going to be like there's nothing put on there. This is going to be like the total amount. So the one that I like to do with it though is like, this is one where you can't just put tick replay on it and see the past history of it. So, I'm just gonna have to show you These ones that are like the difference between the two of them, max difference and min difference, is more interesting. Because what you're going to get is like, okay, let's just ignore this one and let me draw it the way that I would kind of have it and look at it. It's like, this is max asks, and this is max mins. And you're going to find that they're relatively correlated to each other, actually. Like if there's a big increase in the bids, there's or the asks, there's often a big increase in the bids as well, right? But when you compare the two against each other, then you start to get some interesting things. And you'll have like these the max and min, okay? It'll go like this all of a sudden. And you'll kind of find that like the market's doing this, and then all of a sudden it's like it's trending up. It's like when it'll shift across that line, and the behavior will change. And I can't exactly predict like how that behavior is going to change, like when it crosses that line, if that means that we're going to start trending up or down, or what the change is going to be. But like it tends to correlate with changes. So it's like basically, when you look at the difference between the total bids and the total asks, it kind of will help signal to you when a large player is going to get involved. Because they're coming in and they're starting to put more liquidity in the market or take liquidity out of the market. Yeah, so with the max bids, the higher the line goes, that means that there's more bids. So like think of it like this. Okay, here on my Jigsaw DOM, I have this DOM. There's like 4,000 at all these prices. But then when you look at the very bottom of my DOM here, there's this summary row at the end of it, right? And that is all of these columns added up, right? So my indicator is essentially showing you the same thing. But what it's doing is it's also looking at what was the maximum that these were and what was the minimum that these were, to account for these people like constantly moving orders and stacking and pulling and so forth, right? So it's kind of a way of you filtering through the noise. So once you filter through the noise and then you compare the total amount of bids to the total amount of asks, then you start to see really interesting things. Maybe I should change the defaults to just have the difference, because the difference is the way that I would use it. Like let's try here. New window. I'm gonna remove the stuff that I currently have on here, except for the delta. Actually, let's keep market order imbalance on there. Okay. And then I want level 2 changes, and I want resting orders. Okay. And on the resting orders, oh no, I do have it correctly. Min difference, max difference. Okay. And then with the level 2 changes, let's just keep it yeah, let's just keep it like that. Or should I just do total? No, we'll keep it like that. First time in your stream, I follow and like, we need people to share these gurus on Instagram are fake. Listen, it totally bothers me because like, look, first of all, again, I make no performance claims and I am down on the year. But we have information that's like proven information about markets that I think is very important, and it can really, really help you in your trading. Nobody else talks about them. Nobody else talks about them. And it drives me absolutely batty that, like, you know, the entire of the trading world ignores that information that the banks and everything are kind of using for their trading. And they focus on these people on Instagram and stuff that are obvious frauds. Like so much of it is obvious frauds. Obvious frauds or kids that really have no clue. Oh my gosh, there's this person, it keeps, you know, I scroll away, but TikTok keeps showing me this one trader. And the first video that I saw of them was like somebody was calling them a poser. They're like, you're a poser. And they said, oh, like I made $20,000 in one trade. That means I'm a poser. Okay. Yeah. Like bringing up one individual trade as like your trader credentials is like a dead giveaway that you don't know what you're doing, right? Because any trader that's really worth his salt is going to know that like the performance under a 5-year history is kind of useless. Doesn't tell you anything. Do that for 5 years and then come back and maybe you're worth listening to. You know, like if the value, if we're going to base the entire value of listening to you based on your performance rather than whether the empirical evidence backs up what you're saying. Mm-hmm. But that's the way that things are. I think we've done a pretty good job here on our channel of, you know, making videos to teach about those things and kind of, I mean, some of it is you're going to have to learn, you know, go and read some of the books and the studies and stuff. But, you know, I talk about those in the videos. So now we kind of want to zoom out and we, you know, now it's kind of like, okay, well, so there's the trading side of it, but I think it's more than just the trading side of it. It's very, very important for us to understand that the market is not perfectly efficient and that there are inefficiencies baked into the very structure of the market. So markets are not perfectly efficient like we've always been told. They may still be the case, largely because the markets are so chaotic that your best risk-adjusted return is going to be investing in the S&P 500, okay? But the markets are not efficient enough to say, hey, the market moved up, that must mean that this policy is correct, or that this particular decision by a company is correct, or anything like that. That's not the case. Markets can be wrong. Markets are wrong about things all the time. And what we've been doing in our society is we've been saying, instead of saying, what do we know is right? Instead, we say, what do we think the market's going to do? And we make all of our decisions based off of what we think the market is going to do. And when you do that, you start to make bad decisions, is what happens. And this is how you end up with like all of these companies taking on debt to buy back their own stock and, you know, creating all sorts of crazy distortions around in the markets. And it's a big problem because there are a large portion of people in our society that are severely underserved by our society. And why is that? We ignore them because what they're telling us is not what we want to hear. We just want to hear, you know, those sweet nothings that the market's whispering into our ears all the time. Instead of like actually trying to decide, you know, from basic principles what the right decision should be. So we're kind of starting to talk about that sort of stuff now. So index funds, I'm making a video about that. I like 401k is a scam. Yeah, kind of is. I don't think that I would want to say that like in a video, but basically what 401ks did was they convinced the middle class to give up all of their voting rights on corporations in exchange for a slightly, like, this is the crazy thing about it, is like, okay, most funds underperform the market. That is true. Most funds underperform the market. Most funds are not trying to outperform the market though, okay? Most don't. And there are some that do outperform the market very consistently by a very, very wide margin, okay? But they're taking on a lot of risk to do that. How much more is that going to be? Like 2 or 3%, frankly. It's like if you invest, if you keep like 5 stocks and you have a good mix and you really factor in your like you really factor in the beta of the individual stocks, right? Then you will tend to perform roughly in line with the index. And if you underperform, you might underperform it by a few percentage points. And if you outperform, you might outperform it by like insane amounts, because you might catch a 10, 20 bagger or something like that, right? So like the risk reward is actually like very, very much in your favor investing in individual stocks. And so what's happened is, we've given up our voting rights for like a 3% a year difference. It's really worth it. Like, I kind of wonder. So I think that what we need to do is we need to start making agent-based models to model the dynamics of shareholder votes and so forth. So what happens if you come in and you say that you don't get a vote if you don't directly own the shares? The index fund does not get to, because they don't, because they're really owned by the other people. Like an index fund basically gets no vote. Okay. How does that affect the outcome of votes in corporate governance? Right. And we can model that with agent-based, models. And then we can start to do and make other changes. Like, what if the number of votes that you get is proportional to how long you've held the asset for? How does that affect the way that decisions come out in the corporate boardroom, right? And then we can look at all of those and make decisions about how we want to change the system. But what I see right now is a system where basically 3 guys basically get to call all the shots. It's a big problem with that, because they may be doing what they think is right and to the best of their ability, but people are just not. They don't know where their biases are, and they're never going to be conscious enough of it. They are simply not capable of making the best decisions for you because they have different incentives driving them. So the only way to fix that is to get more everyday people like you here in the stream to directly own stocks, care about what's going on at the 5 companies that they own, and vote. And then on top of that, maybe there's other changes that can be made in terms of corporate structure and things like that maybe make it easier to bring certain things and strategies up for votes, and et cetera, et cetera. Okay, so I've had this thing going for a little while now. So, oh, you know what? I didn't do what I wanted to do, did I? Did I do what I wanted to do? Resting orders. Oh, yes, I did. It's just that this one. I forget how to change the order of it, but the min one is kind of behind the other one. Okay, but you will see this this data series will sometimes go across and cross the 0 line and go negative, and then that means that the offers are bigger. And when that happens, you'll tend to see a shift in the market behavior. So that's kind of what I use for that. That's the thing that I'm like, there's got to be a hidden Markov system involved with that, because I can definitely see a change when it crosses. I just don't know what that difference is. So you have to be able to come in and say, okay, there's different regimes, And which regime we are in kind of can be determined by what this indicator says if we're shifting. And then use the probabilities that like it shifts. Okay, so what regime are we most likely shifting into? Something like that. Now this one with the level 2 changes, what I found with level 2 changes is if you see a spike in level 2 changes, and I'm just mentioning this one because I saw that you had it on the chart. When you see like a big spike in level 2 changes, and you'll really see like a big spike, there's usually something will come out after that. Kind of hard to predict which way it's going to be and everything, but like tends to be a good sign that like something's coming. I feel like I'm having a little bit more ADHD today than normal because I've had to reach for some words. Maybe it's because I had salsa with my breakfast, but I was talking about the video. So I have a video about the index fund thing that's coming. And I think I pretty much got that one written out. And then we want to talk about things like, okay, so like what is like a basic approach to trying to invest in stocks, for instance. Kind of taking a look at these higher level things so that we can show people why all this stuff matters. Like I've given you the knowledge. Now it's time to focus on why does it matter beyond just can you make money day trading with it? Well, it seems unclear, but I think that there are societal implications that matter. And we're going to get that out there. I kind of want to close this, but I'm just going to keep it. By the way, the market order imbalance has kind of shifted really dramatically. So you can definitely see it here. Like there is a sell flow coming through here in the treasury. Yen soars after Warhawk. Ishiba wins shock LDP leadership vote. Yo, of course you can ask more questions. That's what we're here for. I run a YouTube live stream because I don't ever want anybody to bother me about I don't really have entry triggers, to be honest with you. So the way that I determine this is I'm going to list out all of the things that I think are going to drive the flows that day. And then add all of those things up and see if there is an imbalance. So if there is an imbalance, then I'm going to take a trade. Now, sometimes I know when those certain flows are going to come because there's like economic releases and things like that. And so I might put off on when I'm going to take it based on those things. But then once we're into the time period where I'm expecting that flow to come through, sometimes I just take it where it is. I mean, there's some downsides to that because like, how do you get the best entry? Sometimes it's just really hard to get a good entry, right? I would prefer to have it, you know, like if I want to buy, let's see it pull back first, you know, let's see it go down a little bit, go into my order. And of course, I utilize what I see on the DOM very heavily. Like if I wanted to buy right now, I think that I would probably try and put my bid at that 16.5. because there's an iceberg of some sort going off at 16.5. So there's a pretty good chance that I would get filled. Those icebergs have a tendency to fill. I wouldn't just hit into 17. You know, it might be worth it. And so I'm looking for little things like that kind of tell me, well, it might be advantageous. If I was going to hit into 17, I think that I would be waiting for there to be less than 1,000 contracts on offer before I would hit it. Like maybe I would put it in there at 17 now, and I would be filled at 17, right? Because it started to iceberg at 17. So I do kind of use those to kind of help my entry, but I wouldn't call them entry signals. I'm merely determining what the flows are going to be, and I want to get in as early as I can. Okay, are the trades displayed in the center based on real market buy and sell orders or just trades between futures contract traders? Also, I don't believe market makers execute on future contracts trades to manipulate the market. Maybe somewhere else, I don't know. Okay, so yes, the center trades are fills. Okay, so we got to go back to how does the order book work? If you put a limit order in, then you basically, you know, like if I click here at 14, that means I've added one buy to the end of the queue here at 114. 14 even, and I'd be like 4, 6, 9, 8 in line, right? In order for me to get filled, they're going to have to come down to that price. It's going to become the best bid, and then market orders are going to come in, and I'm going to get matched up against those market orders. Okay, so we match limit orders with market orders. Now there are like some special situations, like say there's nothing bid or offered at 17. So there's like a spread there. And at the same time, both of I bid at 17 and you offer at 17, they're both limit orders. Those will automatically cross and match as well. Okay. But generally speaking, it's a limit order being matched against a market order. Okay. Now what happens, the way that the data works is you've got your level 2 feed and you've got a matches feed. Okay. So what the matches feed does is every time that a limit order is filled, it will show you that there was a match. Okay. So this kind of is an interesting thing to note, because what that means is that the volume that you see come through, like on NinjaTrader's time and sells, for instance, those are the limit orders, not the market orders. So like if one big market order comes in and takes out everybody on the limit, it will be split up into a bunch of different orders instead of seeing the market order guy. When I think you would kind of be more interested in that it was a big market order that came and took them all out, right? And so what we do is we look at things like when there's a match, is there a corresponding change in the level 2? Or how many corresponding changes are there in the level 2 and, you know, the matches and the timing between them to be able to reconstruct what was actually a market order? Because if it was like a market order came in and like took out all of these all at once, there's only going to be one level 2 change. Okay. Stick with me, and this is relevant to the question. Okay. So now that you have that, now you understand how they sign order flow. Because basically they say this is the best offer and the best bid. If there was matches at 18, that means that those were market orders buying into 18, right? Okay. So that's order flow, essentially. That's the data that we're actually looking at. Okay. So yes, all of the orders that you see in the center are essentially market orders. Okay. Now, can you fake or manipulate with market orders? Maybe, kind of. So one thing that you can do is you can wash trade. I don't think that this is like a very good term, because wash trading is really kind of like a rule that you do with taxes and stuff like that. But there's also what we call wash trading in here, which is like I have 2 accounts and I'm just trading the 2 accounts between each other. So like I'm buying at 18.5 with market orders on one account, and I'm selling with limit orders on the other account. And so I'm moving price up, and it's like, oh, okay, this guy that was the market orders, they pushed the market up 4 ticks and they're probably up a ton. But then this guy that was taking them on, he's going to be down 4. And so those 2 accounts just cancel each other out, and you haven't made or lost anything, but you've moved the price, right? And if you had a position on already, you long, and you moved it up and you've made money from it, right? So that's kind of like wash trading and ladder attacks is what people talk about. Now, granted, to do that sort of a thing, how is that going to work if there's other people in the market, right? There's other people in the market, and you're hitting market orders, you're going to be filling other people than just yourself. So that's kind of a problem, right? Not to mention that it's illegal, and you have to report the accounts and all this sort of thing, right? There's some other situations that we want to talk about with that. I don't know. But another thing could be, hey, I'm a big guy, and I think I can kind of shove the market around, right? So I'm going to buy a ton, and that's going to move it up, right? And then maybe I have some big position already in, so I move it up enough to trigger everybody else to start buying, and then I'll take the profits against them, right? Well, the problem is that your market orders will have an impact and move it up, but your sell orders, when you're getting out, will also have an impact and move it down. And the problem is that your sell orders, because they come second after you've kind of already disrupted the liquidity, that second set of orders will have more impact. And so that tends to not be a profitable trade. Okay. But here's something that you can do. Here's something that people do. Okay. This is the secret. Don't tell anybody. Okay. You can come in and you can say, I want to be long, and I want to take a risky trade. So then what you're going to do is slowly sell it down, and then turn around and buy a ton. So push it down, then push it back the other way. And again, the second order will have more impact, right? So in net, you'll actually push it up more than you pushed it down, and increase your impact on the market, essentially, to kind of shove the market a little bit more your way. Now, to make money with that, you push it down, you push it back up. Now, if you immediately try and take the profit, you're going to have the same issue, and you're going to lose some money, right? But what you can do is you can push it up, and then you can kind of pause and let other people take it, and hope that that movement, encourages them to go long, essentially. And then a few days later, then maybe you take it off, right? That sort of a thing happens. So you can see those sorts of things. When you see those sorts of things, the thing that I would be thinking is, that might be a hedge fund making a risky play there, or a bet or something like that. Is usually where those sorts of things work. Okay. Now, there's a third thing I guess I should talk about when we're talking about like manipulation. Okay. And that is that the market makers out there, there are individual market makers that control a pretty large portion of the market liquidity. Like when we come in here and we're looking at the treasuries, and there's like 3,000 to 4,000 contracts of liquidity at each individual price, like probably 90% of that is controlled by 3 people or 3 market making firms. So they have a big impact on that, essentially, right? And so what that kind of leads to is, if they decide that they don't want to provide liquidity at that location, then it's just going to slip right through there. Okay. That's why you'll get these sorts of situations where, one, they're only willing to put like 500 contracts or less at a price, and it just goes back and forth there forever and gets stuck. That's one kind of situation where that happens. But another situation where that kind of happens is like you start to get a little bit of a trend, and so then the market maker gets scared and he starts pulling his orders, right? And price just slices right through there without hardly any contracts having to trade, right? So where this can be a problem is essentially if we have a market where nothing is really going on, those market makers are going to inject randomness into the market by choosing to not hold liquidity at certain prices to kind of fake you out. So, you know, it's going to be like we come down to the bottom of this range and people start thinking, oh, it's going to break out here. I want to get into the breakout, right? And so then what do the market makers do? The market makers start to say, hey, anytime that market orders start to come in long, I want you to just cancel all of the orders so that it's a lot easier for it to move up than it is for it to move down. They're going to hold the bids and they're going to pull the offers, and price is going to come up here, and then all of those retail traders that sold at the bottom of the range are going to puke and come back out, right? So that is a game that you cannot win. There's all these people out there that you know, they have these ideas about it's going to go through this line and it's a liquidity grab, and it's going to go the other way, and this is nonsense, because a lot of those things that they're talking about would require market orders to do and everything, right? And the problem is that the market maker is reacting to you. Basically, they pulled their liquidity out and they see what everybody does, and then they adjust their bids and offers based on what everybody does. So if everybody came in and said, we're at the bottom of the range here, ergo, we should buy it because the market maker is going to flip it up and come back up to the top end of that range. If everybody starts doing that, or the majority of the noise traders at the time decide to go long, then the market maker will say, okay, fine, then I will just let it fall down here and make money that way instead. So you can't win that game. But it's not like, I wouldn't consider it manipulation. Usually when we talk about manipulation in financial markets, we're really talking about giving people false information to induce them to trade. Okay? But what you do with your orders, that's just trading. Your orders have an impact on the market. It's important for us to understand what that impact is. So one of the impacts that can happen is, you know, if you have a lot of the liquidity and you cancel those orders, then the market can slip through that area very easily. Makes it easier for it to move through there. That's one of the things. So that's probably everything that there is to know about like that particular subject. So what does that really mean? So how do we put it into practical terms? Okay. If you're not expecting a large meta order, that is to say somebody coming in and persistently buying over a very long period of time that will move the market up and create a trend. If you're not expecting that to happen, there is no reason to take a trade. Okay. If there's no such large players in the market and it's just market makers fooling around with retail traders, that's a losing game. Just don't touch it, because they will screw you over every time. I'm telling you, man, they mess with you. Okay. And then when I am expecting that kind of an imbalance, you will see it in the market orders. You have to see it in the market orders because they can't get filled otherwise. So that's how you put it into practical use. Okay, Zhejiang Day asks, can you spot long liquidations and short covering on the price ladder? So you can't prove them. Like there's not any piece of data that we have that would be able to conclusively determine whether an order was entering into a new position or exiting an old position. Unfortunately. There are some markets in China that have like a running open interest that is released to the market every 5 minutes or something like that. And so then you can kind of see that. Then you can see, okay, they came up there and there was a bunch of buying over here. And now I can see that open interest increased. So that means that that buying was opening a new long position, right? And there's been some studies on that kind of suggest that you can use that information to your advantage. Like, it gives you a big advantage, which is probably why you'll never see it in the US markets. Because it would hurt the profitability of the big meta orders, right? And the reality of it, this is something that you really got to understand. If you're like, how do I want to position myself and everything, right? The markets exist for those big players, right? Those big guys that they're gonna buy it all day. Sovereign wealth funds, big banks that have to hedge bond offerings that they're doing, all of these sorts of things. That's who the market exists for. Or if we're in the agriculture space, like we're trading wheat, that market exists for those big wheat suppliers that are growing wheat and they need, some way to hedge themselves. That's who the market exists for. And that's who the CME thinks of first and foremost. They're not thinking about you. They don't make it for you. They do have like these micro instruments to entice you to come in and provide liquidity, but that market still exists so that those big guys have more liquidity to execute against, right? So keep that in mind. That's who they're trying to keep happy. So what do you want to do? You want to jump on board. You want to make life easier for those guys. You want to, okay, I think that they're coming in. I'm going to quietly acquire some inventory before anybody knows what is happening. And then when they come in and they move the market up and they're trying to buy a ton, I'm going to sell it into them. And they're going to be very grateful to me because I just gave them I provided some liquidity for them to buy into, right? And you don't want to take too much of it so that it moves way beyond before they even get started. And then they don't get as good of a price as they wanted. You don't want that to happen, right? So, but that's who the market's for. Why would they think of someone who is trading 5 micros in the ES? Well, I tell you what, man, like, here's the thing, is that when you get into those quiet markets where there are no big players like that, there are situations, I honestly believe that there are situations where, like, if you had a time machine, you could go and look at one timeline where you submitted your order and one timeline where you didn't submit your order, and you would be able to see a difference in the prices. I really do think that situations like that happen, and they're going to be more likely to happen when there's not a whole lot going on in the market, especially if it's like overnight session. And the problem is that you might just be thinking about yourself, but like there's other people out there too, right? There could be a ton of retail traders seeing the same thing that you're seeing and deciding to get in and doing something. That's why you tend to get screwed over. Like, think of it like this, okay? If we had the game, I really need to make this game. Maybe we'll have some time to do it, okay? Let's make a game that's like rock, paper, scissors. Except for that in this game of rock, paper, scissors, it's all of you against me. Okay? And furthermore, I get to make my decision after you've all made your decisions. So then how am I going to do things? I'm going to look at what the majority of people decided, right? So let's say that 60% of you chose rock. Then what am I going to do? I'm going to choose paper and win against that 60% of you, right? And then, I'll lose against the people that did scissors, and it'll be break even against the people that did paper, right? But I won against the majority of the people, right? Yeah, it doesn't sound like a very fair game, does it? But the thing that's interesting in this game is, so if you continue to play that game against me, what's going to happen? You're going to lose most of the time, right? It's like it's rock, paper, scissors. It should be random, right? And the decision that you're making is random because you don't necessarily know what everybody else is going to pick at that time. And yet, you're going to end up losing most of the time. There's going to be this one, like if we do this statistics, like I want to be able to do it. We'll play the game, and then we'll show the statistics afterwards. We'll play like 50 rounds, and then we'll see who won the most and who lost the most. And what you're going to find is a distribution like this, where like most people lost, and then there's a few people that for somehow they just guess right every single time, right? But most people are going to lose because of the way that the game is set up. And that's essentially what happens with the market making, right? The market maker has an advantage over you. So you really don't want to trade when it's just you and the market maker. That's when they can kind of manipulate things and screw you over, okay? Now, when there's a large meta order in the market, that's a different thing. And that's when there's these things where people are like, we're having a large meta order and it's going down, and people say like, oh, well, here was this previous day's low, and it's going to come back, and then it's going to come to the fair value gap and bounce higher or something like that. Well, okay, but what if this was the first leg of a meta order, and there's going to be another leg of the meta order 45 minutes later right here, right? Then guess what? They're going to sell it through there, and you're going to get absolutely destroyed. So when it's just the market maker in the market, I say no edge. Maybe you can find an edge against them. Maybe your edge can be you're going to be taking fills and you just have a larger stop than them, right? That's a risky game to play. But when there is a big meta order in the market, all that matters is the meta order. And if you can predict the meta order, then you're going to make money. And if you can't predict the meta order, then you're probably going to lose, right? So market maker, no edge. Large meta order, you do have an edge if you're able to predict the meta order, if you know that the meta order is there. So this idea that like there's going to be manipulation and stuff against these large meta orders is kind of silly, right? It's like, who's going to be dumb enough to come in and do this? I'm going to manipulate price. I'm going to try and make it up to make this higher low sort of situation and everything because I'm manipulating the market, right? Like that's a super risky game. So I have to use market orders and everything to kind of make that happen to some extent. And then there's just going to be some large meta order that's going to come in and destroy me, right? Because in that situation, manipulation is not going to be an edge. The only edge is going to be being in line with the large meta order. So yeah, that's why when you kind of take the approach that we take to markets, like this whole nonsense about manipulation, it's not really something that you have to think about. All I have to think about is there going to be an imbalance? Do I think that there's going to be these large players that are going to come in and buy and sell it? And why? What are the things that might drive them to do it? Like something that's going to drive them to do it today, although maybe not so much today, maybe more of it will be on Monday. But end of month flows, you have to rebalance your portfolio. That's a big flow that moves markets. And if we can predict that that rebalancing is going to cause buying, then we can come in and we can buy it before those guys come in and rebalance it and make money off of it, right? That's what we're trying to predict. Okay. And that's it, is predict a meta order. And if you don't have information that suggests that there's going to be some imbalance that creates a large meta order like that, then you don't do anything. Easy. And every time that there's a move, we can look at it and we can say, well, what might have been going on at that time that might have driven that meta order? what was, sometimes it's endogenous, sometimes it is just like somebody's puking, and yeah, you know, you never know. But most of the time we can, especially for the really big moves, have a pretty good idea by the end of the day what was driving it in the treasury. So that's the way that I trade. And that's why it's kind of like, yes, even though like you individually don't matter, you still shouldn't play that game. It's still going to be a losing game for you. Well, anyways, I've got some things to do today. I think Friday, I don't think that there'll be as many places to apply to on a Friday. But we'll see. I have a programming project to do now. So I will see you guys tomorrow. In the meantime, stay excellent, team.